Hi, I'm Adam Smith, Chairman of the House Taxation Committee for the Kansas House of Representatives. Who wants to talk taxes? To be honest with you, probably not my favorite subject either. But I would like to take an opportunity to visit with you about something you may have heard a lot about lately, a flat tax.
Okay, first of all, what is this flat tax everyone's talking about? It's simply a way of saying an income tax code that uses one single flat rate. In order to understand how a change to single rate income tax could impact your income tax, let's first go through a basic explanation of our current tax code in Kansas. We have three different rate brackets with income thresholds. For a married couple filing a joint income tax return, the tax rate is 3.1% on the first $30,000 of taxable income, 5.25% between $30,000 and $60,000, and then 5.7% for income over $60,000. When our current tax code is charted on a graph, it looks something like this. As the percentage increases, the slope of the line also increases and forms somewhat of a curve. Conversely, a single rate tax code is the same percentage rate for everyone and yields a graph more like this. I'd like to share with you a few of the common questions I hear as legislators consider adopting a single rate income tax code. It's my goal to have all of these questions answered by the time we finish this little presentation. Doesn't this raise taxes on the lower income tax filers? A few slides ago, we learned that the lowest rate is currently 3.1%. If we adopt a single rate that is higher, won't that result in an increase? That's actually a great question, and we will definitely answer that one first. I've also heard, isn't this just a tax cut for the rich? And isn't it too expensive to adopt a single rate income tax policy? These two are very good questions, and we will have the answer to them very shortly. Here's one I get a lot. Isn't a flat tax regressive? We're going to discuss this and learn how even a single rate income tax can actually be progressive and provide significant tax relief to the lowest income earners. Last but not least, I also hear references to prior attempts at income tax reform. This concept is much different than what happened a decade ago, and I will be happy to answer this question as well. But before we dive into those questions, let's take a quick visual look at our current tax code so we have a better understanding of how it works. Here's a graph of what our current income tax code looks like. Along the bottom axis is the starting point at which we begin calculating our Kansas income tax, the federal adjusted gross income. Along the left axis is the amount of Kansas income tax owed. The red line is the visual representation of how much income tax you would owe as a married couple filing a joint return. In order to see more detail, I'm going to zoom in a little bit for our next step. All right, first of all, I want you to notice how the red line is flat at the beginning. Why is that? When you begin calculating your Kansas income tax, our current tax code has three exceptions to subtract from your federal income. The first is the standard deduction. Using our example of a married couple, the standard deduction is $8,000. The next is the personal exemption. This one is worth $2,250 for each member of the household, or in this example, $4,500. This point, at $12,500 of federal income, is where we begin determining the Kansas taxable income. However, the tax owed still shows at zero for another $5,000. This last exception is called the zero liability threshold. Even though the formula has begun calculating your income tax, there is a provision in the law that says you don't owe anything until you have over $5,000 of taxable income. Then there's a little jump because after you exceed that level, you owe from the original starting position. From here, the first rate of 3.1% is applied until you hit the income threshold for the next rate change. That second rate, as we learned earlier, is 5.25%, and then it changes to the final rate of 5.7%. Now this graph goes to $100,000, but in theory, this chart would continue on at the 5.7% rate for all higher income levels. Now there is a peculiar part of our tax code that I'd like to explain further. In this example, a married couple with, let's say, $80,000 of federal income does not pay a full 5.7% on their Kansas taxable income. They actually pay 3.1% on the first $30,000, then 5.25% on their next $30,000, and finally 5.7% on the final $20,000. That may sound strange, but there is a good reason for it. Without that, if exceeding the income thresholds put your entire income into the next bracket, this graph would look more like this, where earning that next dollar that put you over the threshold would result in a $650 surprise as your tax rate jumped into the higher level. Now that we have a basic understanding of how our current tax policy works, let's take a look at a hypothetical single rate tax and how that would look on the same graph. As shown in an earlier slide, a single rate yields a straight line. Here is what a theoretical 4.5% rate would look like. However, I think this line is highly problematic. Knowing what we do about our current code, can you tell me why this blue line would be so bad? If the red line represents our current tax, anything above the line would yield a tax increase. The ideal target is to make sure no one sees a tax increase due to changing the policy. So we need to create a policy that draws the blue line actually below the red line at every point in this graph. This example would be horrible policy because it would result in a substantial tax increase for most Kansans. Is it possible to fix this? Well, let's take it one step at a time and give that a try. First of all, this blue line starts at 0, I'm sure you notice. Our current tax code recognizes the burden of taxing the very first dollar. And you remember we have 3 exceptions to move that starting point. Let's go ahead and apply those same provisions to the single rate and see what happens. First was the standard deduction, which moved the starting point to $8,000 on the federal income. Next was the personal exemption, which moved the point another $4,500. And last, the zero liability threshold. That's interesting. It looks like this results in a tax decrease at first, but then a tax increase for moderate income households, and then back to a tax decrease as income levels rise. We can now visually see the low point at about the $42,500 income level. Let's focus on that. In order to avoid a tax increase for anyone, we would need to move that blue line one more time. By increasing our liability threshold, we now have that blue line representing our single rate tax structure completely below the red line of the current tax policy, which means a tax break for everyone. We have just answered the first question from earlier. Doesn't this raise taxes on lower income tax filers? And the answer is a single rate income tax can be adopted without a tax increase. While we have shown that there is no tax increase for anyone, the tax cut is not equal for everyone. Can we fix that? We're comparing a straight line to an overall curved series of straight lines. So it won't be possible to have everyone receive the same amount of tax relief, but maybe we can make it a little more fair at least. Let's give that a try. First of all, let's zoom out to $250,000 of federal income to give some perspective and so we can analyze higher income levels. 97% of income tax returns are less than $250,000 in Kansas, but the top 3% account for almost 35% of the individual income tax collections. This blue line represents a tax rate of 4.5%. Let's analyze this further by looking at the extremes. What if Kansas adopted a single rate at our lowest current level of 3.1%? Wow, that doesn't look very fair. A married couple making $50,000 or less wouldn't see any tax break, whereas a similar couple making $100,000 would get about $1,500 in tax relief, and a couple making $250,000 would get approximately $5,000 in tax relief. This example would not only be unfair, but also unfeasible without tremendous budget cuts. It would cost billions of dollars to implement. Well, let's take a look at the higher rate, 5.7%. This clearly shows adopting the highest rate would yield tax cuts only at the lower income levels. This scenario shows the absolute minimum amount of revenue reduction to the state by adopting a single rate income tax structure without increasing anyone's taxes, which is very appealing. However, when it comes to tax policy, we also must consider how competitive our rates are with respect to our neighboring states. That was one of the biggest reasons for lowering our sales tax rate on food. We were the highest in the region, and 2 neighboring states had no tax at all on food. Looking at our neighbors, Colorado has a single income tax rate at 4.4%. Missouri is at 4.9%, Oklahoma is at 4.75%, and Nebraska is currently at 6.64% and has a mechanism in place to reduce that rate by 0.2% every year. Now, let's take a final look at our current middle rate of 5.25. As you can see, this scenario would provide tax breaks at the lowest and the highest levels, and there would be no tax cut for the middle group. Now, additional increases in any of the 3 exceptions, the standard deduction, the personal exemption, or the liability threshold, would retain the same slope but move the blue line a little bit further to the right on the graph, and this would result in a tax break for that middle group. Remember, however, as the gap between the lines increase, so does the cost to the state to implement the new policy. We now have enough understanding of our current tax code and several different scenarios with single rates to answer more of those questions at the beginning of this presentation. How about, isn't this just a tax cut for the rich? From our 3 examples, we now understand the answer is, it kind of depends. The 3.1% rate certainly focused the tax relief on the highest incomes, definitely a tax cut for the rich, while the 5.7% rate provided tax relief to the lowest earners, and the 5.25% rate was kind of in the middle. Ultimately for Kansas, this rate could be anywhere. Legislators simply need to decide what amount of revenue reduction they feel is sustainable and make a proposal with the rates and thresholds set accordingly. Let's go to our next question. Isn't it too expensive to adopt a single rate income tax policy? Well, as we learned by looking at the scenarios, if you minimize the gap between the red and blue lines, the revenue change is minimized. It would be possible to adopt a single rate policy with essentially no revenue change. Using what you've learned, can you see how we could do that? That's right. You would have to move the blue line to the left until there was a balance between the households receiving a tax increase and those receiving a tax decrease that was essentially at net zero. I'm pretty sure no one at the Capitol is interested in raising taxes, but I did want to show that it would be possible. Let's move on to the next question. Isn't a flat tax regressive? Again, this depends on a reasonable rate. We saw that a 3.1% rate was not reasonable at all. and a 5.7% rate focused the tax relief on the lowest earners, but did not place us in a very competitive position with our neighboring states. A new single rate tax code would not be regressive as long as our standard deduction, personal exemption, and zero liability threshold remain set at dollar amounts rather than proportionate to the total income. The debate around regressive policy is that taxes are disproportionately a higher percent of lower income relative to households with higher income. However, fixed dollar amounts at the exceptions are the same whether you make $40,000, $140,000, or $400,000. They are a much higher percentage of lower income and proportionately provide more relief and benefit relative to higher incomes. Therefore, they actually create a more progressive view on the single rate tax policy. And how about that last question? Is this a repeat of the 2012 tax experiment? It is actually different in several ways. First of all, a single rate policy does not eliminate income tax for businesses. The 2012 policy took certain business taxes all the way to zero immediately. Next, there is no mechanism in a single rate income tax policy that is designed to eventually eliminate all individual income tax. A mechanism could be placed into law that would reduce the rate over time, but that is above and beyond the simple concept of a single rate policy. Also, if the legislature sets a reasonable income tax rate and reasonable amounts for standard deductions, personal exemptions, and liability thresholds, a single rate income tax structure can be implemented at a relatively low cost and sustainable without creating budget problems for the state in the future.
I hope this video has given you a better understanding of what a single rate income tax structure could look like in Kansas, how it compares to our current 3-bracket system, and how it could impact your family. Thanks for listening.